A&J Capital. Today's video will be about should you sell options. I'm assuming you already know what options are. Options give you the right but not obligation to buy a certain stock at a set price, the strike price, sometime in the future, the expiration date. Beauty with options is you could take the other side of the trade. When you buy a call, when you buy a put, somebody's selling that to you, and you could be the person selling. The call, right? You have a call, you want the stock to go up because then the value of the call should go up. But that's not always the case. There's two things that stop that from happening. Are the Greeks. I'll get into the Greeks in another video. But theta is time decay, meaning every day you hold that option, you lose money. Regardless if the stock goes up, stays flat, goes down, you're going to lose money every day from time decay. And vega is volatility. Let's say you're buying calls for an earnings event. Earnings brings volatility because people don't know which way the stock's going to go. They don't know if it's going to be good news or bad news. So after that initial move happens, where, okay, they announce earnings, and regardless if it's good or bad earnings, the move already happened. So people aren't expecting another big jump because the big jump would have came from the earnings. So sometimes, right, you'll buy the call, the stock goes up, but the value of the call goes down. And that's because of this. These could be negative for you. Let's say it's 10 cents you lose every day when you originally bought it. As it gets closer to expiration date, right, this is expiration, you lose more money. Let's say it's 50 cents or 80 cents every day. You don't lose as much money early on. Let's say you bought it in January, just because you have time on your side. But as time gets closer to expiration, the theta increases, which means you lose more money every day you hold it, which is a negative. You're fighting against the clock. Let's say the market was expecting a plus or minus move of 15%. That's a big move after an earnings announcement. But in reality, it only moved 9%. If the market was saying, okay, this call option is worth $9, that's before the move happened. They were expecting a large move for make that worth $9. If the move happened and it wasn't as strong as a move they expected, this is going to go down. It could be frustrating buying calls or buying puts. Going directional is what they say. Because you can be right, you pick the right direction, you're like, okay, I got it, boom. Then the stock goes down. I mean, the value of the call goes down. And then you're like, oh man, what happened? The theta happened, the volatility collapse happened, and you had to pay for it. If you took the other side of the trade, you could have benefited, right? You sell an option, you sell a call option, you actually want the value of the stock to go down, or at least stay flat. Because when you sell a call, it's kind of like shorting a stock, where you sell, let's say you sell at $4, and then you buy it back at $2. That's a $2 profit. The risk is what scares people out of selling options or writing options. You'll see this word, unlimited. Oh, you don't want unlimited losses. You don't want you to sell a call and the next day the call option's worth 100 times more than you thought it would be. That doesn't happen all that often. But a lot of contracts, they expire worthless, right? And that's what you want. You want the call option to expire worthless. Because when you buy it back, you're buying it for pennies, and you make the difference between where you sold it and where you bought it back. So risk is unlimited, and risk is limited. If you sell a call option for $3, that's the most you can make. That's the most, because if this goes to zero, then you would collect the whole thing. You would collect 100%. This could be seen as an income strategy, because you want to profit every Friday, essentially. If you're selling options for the Friday, then you would collect every Friday, like a check. Instead of a call where it has to go up, and it has to go up pretty significantly for you to make money. With selling, you can make money if it goes down, and you can make money if it stays flat. So that's the beauty. If a call option stays flat, the value goes down, which you don't want if you're buying it. It's the same concept with puts as well. So let's say you sold a call and it went up and you get assigned. You get assigned meaning you have to fulfill that agreement. You have obligations as a seller. If somebody wants to exercise those contracts, then you're the one being assigned. You're the one who has to buy 100 shares and sell it to them. So one of the things with selling options is you do need a little bit more money because there is margin requirements. You need some money just so your broker knows that you can afford it. Selling calls, selling puts, should you do it? Short answer is yeah. It's not as risky as you think. Most contracts expire worthless. Most people overpay for options. And as a seller, you could benefit from that. Most of the time, the market predicts a larger move than expected. You could profit off that. I'll get in further with strategies in which you could sell options. But this is just a quick overview. Should you sell options? Try it out. Try it out on a small price stock, a $10 stock. See if you like it. See if you like the income strategy. See if you like not having to worry that the stock didn't move as fast as you wanted to move, or it stayed flat and you lost money. A&J Capital.